Welcome to this deep dive into SCYNEXIS, ticker SCYXis.
Good to be here.
Today we're pulling together the latest info, financials, analyst takes, the whole economic picture.
Right, trying to synthesize it all.
Exactly. The goal is to get a clear view of SCYXis right now, what might be coming, and, what that could mean for investors.
But without getting totally bogged down in every single detail.
Precisely. Think of it as the key insights.
Your essential guide, maybe.
Yeah.
We'll look at their progress, the money side, and how the wider economy kind of fits in.
Okay, let's jump right in then. A big piece of news recently is on the regulatory side.
Ah, yes, the FDA agreement.
Right. They've agreed with the FDA on a strategy for their oral drug, fungerp. That's for treating invasive candidiasis.
Which is a pretty serious fungal infection, yeah.
So why is this FDA agreement such a big deal for them?
Well, it basically gives them a clearer roadmap, potentially, for getting this drug approved.
Okay.
See, invasive candidiasis, it's tough to treat. Usually it's IV treatments.
Right, in a hospital setting, often.
Exactly. So an oral option like a fungerp, that could be a major advantage.
Yeah.
Easier administration, maybe even treatment outside the hospital.
Makes sense.
So this agreement, it signals they're moving forward, clearing those regulatory hurdles. That's always a critical step for any biotech, like getting a green light for the next phase.
Got it.
So progress with the regulators. Let's switch gears to the numbers, the financials.
Okay.
We've got some figures on their earnings versus operating cash flow. Q3 2024. Operating cash flow was negative $33.6 million.
Ooh.
Yeah, and that was like 21.3% worse than their reported earnings.
So burning more cash than the earnings figure suggested.
Right. Then Q4 2024, still negative $10.6 million, but closer only 2.8% worse than earnings.
A bit better, but still negative.
Looking at the full years is interesting. 2022, actually positive operating cash flow, $39.1 million, about 67% of earnings.
Okay, so they were generating cash then.
But then 2023, it flipped. Negative $13.6 million, which was almost 89% of earnings.
Wow, quite a swing.
And the trailing 12 months show the same thing, negative $13.6 million, 88.7% of earnings. What do we make of these swings?
Well, that flip from positive to negative is definitely something to notice. 2022 looked pretty healthy cash-wise relative to earnings.
Yeah.
But the negative trend in 23 and more recently suggests that while the earnings numbers might say one thing, the actual cash flowing through the business isn't quite matching up.
Why might that happen?
Could be several things. Maybe delays in collecting payments, maybe higher spending on R&D or operations that isn't immediately reflected in the earnings calculation in the same way.
I see.
For investors, consistent positive operating cash flow is usually what you like to see. It suggests sustainability. So this variability is definitely a point to watch.
Right. Okay, let's dig into something called accruals as a percentage of sales.
Accruals, yeah, basically revenue recognized before the cash comes in, or expenses booked before cash goes out.
Gotcha. So Q3 2024, actual accruals were super high, 103.4% of sales. But the forecast was way lower, 58.2%. Then Q4 24, again, a big difference. Actual 91.4% versus a forecast of 43.1%.
So reality was much higher than expected in both quarters.
Exactly. Looking ahead, though, the forecast for 2025 come down quite a bit. Q1 is forecast at 69%, then down to like 27.5% in Q2, 38% in Q3, and under 20% for Q4.
So what does this accrual picture tell us?
That's the question.
Well, high accruals, especially when they're way off forecast, like in late 2024, can sometimes be a bit of a, well, maybe not a red flag, but something to understand.
Meaning?
It could suggest that the timing of their cash flows is pretty unpredictable compared to when they're booking revenue or expenses.
Okay.
But the fact that the forecasts for 25 show them coming down, that suggests an expectation that things will get more aligned, that sales and cash collection will track closer together.
So maybe they expect to get better at turning sales into cash quickly.
Potentially. Or maybe the nature of their revenue streams is expected to change. It's like, selling a lot on credit versus getting cash up front. The forecast suggests a shift towards more cash up front, maybe?
The report also mentions some adjusted financial metrics. Adjusted operating cash flow, adjusted free cash flow.
Right, trying to smooth out the one-offs.
Yeah, taking out unusual items. And then adjusted EBIT margin and adjusted net margin, basically profitability adjusted for those one-offs.
And ROI-ICE, return on incremental invested capital.
Right. How well they use new money invested. We don't have the specific adjusted numbers here, but why are these adjusted metrics useful for a company like SCYNEXIS?
They're really important for stripping out the noise. Biotech companies often have big, lumpy R&D costs or maybe one-time payments from partnerships.
Oh, okay.
Adjusted figures try to give you a clearer look at the underlying sort of core ongoing business performance. Is the fundamental operation profitable? Is it generating cash?
And the ROIs.
That's key for growth companies.
Huh.
It tells you if the money they're reinvesting back into the business, like for R&D or launching a new drug, is actually generating a good return. It's about capital efficiency.
Makes sense. Okay, let's shift to what the analysts are thinking. Wall Street's take.
Always interesting.
The average 12-month price target is $5. High target is $6. Low is $4.
And what was the price when the report came out?
Around $0.88.
So $5 average target versus $0.88.
Yeah, the report calculates it as a potential 471% upside.
Wow. Okay. Based on how many analysts?
3 analysts covering the stock.
3. Okay. So what do we make of targets that high?
Seems incredibly optimistic, right?
It certainly grabs your attention. It implies these analysts see some major positive developments ahead.
Like the drug approval and launch.
That would be the most likely driver, yeah. Successful launch of fungerp, maybe hitting sales targets faster than expected, or perhaps potential in other pipeline areas we don't have details on here, maybe even new partnerships. But yeah, huge caveat. These are predictions. They're based on assumptions.
And assumptions can be wrong.
Exactly. Analyst targets can change quickly, and sometimes, let's be honest, they can be overly optimistic, especially for development stage biotechs. You really need to understand why they have those targets.
Good point. Always look under the hood. Let's look at earnings per share, EPS.
Okay.
Q1 2024 was actually positive, 0 low on 9s, but then negative. Q2 was $9.30. Q3, $0.06. Q4 $0.09.
So mostly losses in recent quarters.
Yeah. And the estimates for the first half of 2025 are also negative. Average of netted of 0.175 cents for Q1, netted of 0.165 cents for Q2.
Still burning cash per share.
But look at the annual figures. Actual for 2023 was unnetted of 39-cent positive EPS.
Oh, interesting. A positive year then. Probably due to some specific event or deal.
Could be, but then the estimate for 2024 is negative $0.44.
Back to losses.
Then for 2025, the average estimate is still negative, but less so. Negative $0.315.
Okay, improvement expected.
And then 2026, the average estimate jumps way up to positive 0.685.
Ah, there's the turnaround analysts are expecting.
But there's a really wide range around that 2026 number. High estimate is $1.87. Low is negative $0.20.
That wide range tells you a lot, doesn't it?
Yeah, huge uncertainty.
Exactly. The potential for that big positive EPS in 2026 is there, likely tied to fungerp sales really taking off.
Right.
But the low estimate being negative shows there's also a scenario where things don't go nearly as well. Maybe slower launch, higher costs. Investors really need to consider both possibilities. What drives the best case? What leads to the worst case?
Good point. Interestingly, though, looking back at earnings surprises over the last 12 quarters, so 3 years, SCYNEXIS actually beat analyst estimates 2/3 of the time.
Oh, really? 67% positive surprises.
Yep, only 1/3 negative surprises and 0 times exactly in line.
That's potentially encouraging.
How so?
Well, a pattern of consistently beating expectations could suggest management is good at executing, or maybe that analysts are habitually a bit too conservative with their forecasts for the company.
Or the company guides conservatively.
That too.
Yeah.
Either way, it can sometimes build a bit of confidence.
Okay. Let's talk revenue, the top line.
Right.
2023 revenue was $140.1 million.
Okay, decent number.
But 2024 plummeted. Just $3.7 million.
Wow. That's a massive drop. What happened there?
The report doesn't detail the exact reason, but yeah, a huge decline.
That probably needs some digging into. Timing of milestones, end of collaborations, something like that must be behind it.
Probably. But then look at the forecasts. Average estimate for 2025 is $20.6 million.
Okay, a rebound from that low 2024 number.
And then 2026, a huge jump again to $72.8 million on average.
Right, there's that expected ramp up again.
The growth rates are crazy. Forecasted growth of 449% for 2025.
Off that very low 2024 base, yeah.
And then 1,843% growth forecasted for 2026.
1,800%. I mean, those numbers are almost certainly banking entirely on fungerp hitting the market and gaining traction fast.
Has to be, right?
It's the core of those optimistic analyst targets we talked about. But achieving that kind of explosive growth, that's a huge challenge. Execution has to be flawless. Investors need to track that very closely.
Definitely. The report also flagged some fundamental points. Highest gross margin in the pharma industry. 100%.
100%. That is remarkable. Means the direct cost of goods sold is essentially zero or close to it.
What does that usually imply?
Usually implies strong pricing power, maybe royalty revenue, or perhaps very low manufacturing costs for whatever generated that revenue. But remember, gross margin doesn't include R&D, sales, marketing, admin costs.
Right, those operating expenses.
Exactly. So while 100% gross margin looks amazing, you need to look further down the income statement.
Okay. On the flip side, their operating cash yield has been lower than the industry average for 5 years.
Right. So despite potentially high margins on sales, they haven't been as efficient as peers at converting that into actual cash relative to their market value. Connects back to our earlier cash flow discussion.
And one more point. They're one of only 63 pharma firms with no long-term debt.
That's a definite positive, especially now with interest rates being what they are.
Less financial risk.
Absolutely. A clean balance sheet gives them flexibility, reduces vulnerability. It's a good sign.
Okay, let's look at the stock's behavior. Short-term, last 90 days, it's had a high correlation with the S&P 500.
So moving with the general market tide recently.
Yeah. But longer term, over 5 years, the correlation is just average.
Interesting. So maybe more driven by company-specific news over the long haul, but recently caught up in broader trends.
Perhaps. And volatility. In the last 90 days, its price has been more volatile than 92% of S&P 500 stocks.
Wow, very volatile then.
And the beta measuring sensitivity to market moves is 1.15 versus the S&P and 1.31 versus its peers.
Both above 1, meaning it tends to move more than the market or its peer group, up or down.
So higher risk, potentially higher reward, tied to market swings.
That's generally what higher beta and volatility imply, yes. Pretty common for smaller biotechs. They swing more.
The risk analysis numbers really show that. Best day in 90 days was plus 18%, worst day negative 6.7%.
Big swings.
Biggest intraday swing was over 19%. And looking back 5 years, best month was plus 101%, worst month negative 35%.
Yikes. Yeah, that really paints a picture. Not for the faint of heart, perhaps. You need to be comfortable with those kinds of ups and downs.
Let's touch on a technical indicator, the RSI Relative Strength Index.
Okay, measures momentum, overbought, oversold conditions.
For SCYNEXIS, the 10, 50, and 200-day RSIs are all in the low to mid-40s. Industry averages are similar.
So not extreme. Below 30 is often seen as oversold, above 70 is overbought, mid-40s is, well, neutral territory.
Doesn't scream buy or sell based on momentum alone?
Exactly. It suggests the price is kind of consolidating, not strongly trending one way or the other based on that indicator right now.
What about seasonality? Historically, over 10 years, April's been a decent month for SCYNEXIS, average return 7.2%.
Better than the industry average for April, which was slightly negative.
Yeah, but May and June tended to be weaker for SCYNEXIS compared to the industry.
Interesting historical pattern, but, you know, the usual disclaimer applies.
Past performance is no guarantee.
Yeah, right. More important to focus on the current situation.
Okay. Who owns the stock? Top institutions include Federated Hermes, Kingdon Capital, Vanguard. Stakes between roughly 1.6% and 7.4%.
So some recognized names holding positions.
And top executives also hold shares directly. Does institutional ownership matter?
It can be seen as a positive signal, yeah. When sophisticated investors like institutions take significant stakes, it implies they've done their homework and see value.
And insider ownership
Aligns management's interests with shareholders, generally a good thing.
One more technical point mentioned. The 10-week moving average is below the 40-week moving average.
The death cross concept for some technicians.
Is that what it is? It says it's often seen as bearish.
Yeah, in technical analysis, when a shorter-term average crosses below a longer-term one, some interpret it as signaling a potential medium-term downtrend or weakening momentum. But again, it's just one indicator among many.
Okay, got it. We've covered a lot on SCYNEXIS itself. Let's zoom out now.
The big picture. Macro context.
Exactly. Because, you know, the economy affects everything, especially investment sentiment towards sectors like biotech.
Definitely.
The Allianz report talks about a full-fledged trade war initiated by the U.S. higher tariffs, especially on China, but others too.
Right, pushing up the average U.S. import tariff rate quite a bit.
Yeah, significantly. They think maybe some bilateral deals could lower it eventually, but for now, it's causing uncertainty.
And companies are reacting.
Yeah, front-loading imports, trying to diversify supply chains, adjusting prices. The report suggests maybe 2/3 of U.S. companies might pass tariff costs to consumers.
Which could fuel inflation.
Could. And they also see a rise in global business failures, insolvencies projected for 2025. U.S. and Western Europe seeing notable increases.
So a tougher global economic environment predicted.
Seems like it. How does this kind of uncertainty, trade wars, potential slowdowns, how might that hit a biotech like SCYNEXIS?
Well, several ways, potentially. First, investor sentiment. In uncertain times, money tends to flow away from perceived riskier assets.
And biotech is often seen as higher risk.
Generally, yes, especially companies not yet consistently profitable. So it could make fundraising harder, or valuations might come under pressure.
Okay. What about direct impacts?
Direct impacts of tariffs. It's unclear from the sources if SCYNEXIS relies heavily on specific imports affected by these tariffs for, say, research materials or manufacturing components.
We don't have that detail.
Right. But any disruption to global pharmaceutical supply chains could potentially have knock-on effects, increasing costs or causing delays, even indirectly.
The Alliance report also mentioned tighter U.S. immigration policy potentially dampening long-term growth.
Yeah, potential impact on workforce size and overall economic potential.
On the other hand, they noted some fiscal spending in Europe, like Germany, might offset some headwinds. But overall, slower global growth, U.S. growth volatility, risks tilted downwards.
And inflation's still a concern in the U.S., even as it cools elsewhere.
Right. Interestingly, their sector analysis didn't flag pharma as specifically negative from trade wars. Automotive, textiles, retail were mentioned negatively.
That might suggest the demand for medicines is seen as less sensitive to these trade issues compared to consumer goods or cars. Healthcare needs tend to be more resilient.
Okay, Deloitte's U.S. forecast echoes some of this. They also see slower U.S. growth in 25 and 26.
Due to similar factors. Trade, immigration changes.
Yeah, and they mentioned the potential extension of the TCJA tax cuts as an assumption in their baseline. They even have a downside scenario.
What does that involve?
Increased deportations, bigger government spending cuts, leading to much slower growth and delaying any Fed rate cuts.
So reinforcing that uncertain outlook.
Definitely. And while consumer spending was strong, they say confidence is falling now. People are worried about tariffs and inflation expectations are rising.
That fits with the inflation picture.
And Deloitte thinks the Fed might only cut rates twice in 2025 because inflation is proving sticky.
So maybe not the relief from higher rates that some were hoping for soon.
Seems like it. This continued inflation and slower growth, it just creates a more challenging backdrop, doesn't it?
It does. For biotech, it could mean, as we said, a tougher funding environment, higher costs if inflation persists, less investor appetite for risk.
We even saw a direct market reaction described in an AP News report from April 7th.
Oh, yeah. What happened?
U.S. stocks closed lower after President Trump renewed tariff threats. Lots of volatility. A false rumor about a pause caused a brief spike.
Markets on edge.
Totally. China likely to retaliate. Hong Kong market plunged. Oil prices dipped. Even Bitcoin fell.
Shows how sensitive markets are to this trade rhetoric right now.
Some experts quoted were worried about a possible bear market, comparing it to 2020. All major U.S. indexes were down, big names like Apple, Caterpillar.
So it wasn't just a small wobble.
No, significant declines across the board, globally too. Asia, Europe. Panic Monday, they called it.
Wow. That really highlights the risk aversion triggered by trade war fears.
Yep.
And that could definitely drag down stocks like SCYNEXIS, given their higher beta and volatility.
Exactly. It gets caught in the downdraft.
Even if the company itself isn't directly targeted by tariffs, fear spreads.
Okay, one last piece of context. A report from a National Security Commission warning the U.S. might be falling behind China in biotech.
Oh, interesting. National security angle.
Yeah, and recommending billions in federal funding over 5 years to boost the U.S. biotech industry. There's even a proposed act to support this.
So potential government support coming for the sector.
That's the recommendation. The report apparently revised its view, saying the U.S. is now falling behind China in key areas.
So while we have these macroeconomic headwinds, trade wars, slowdown fears, there's also this potential push for more domestic investment in biotech.
Seems like it. Now, the report doesn't mention SCYNEXIS specifically, obviously.
There's not, but
a stronger overall U.S. biotech ecosystem, potentially fueled by more government funding, that could be a long-term positive, right?
Absolutely. It could create a better environment for innovation, maybe more funding opportunities down the line, more partnerships, more talent, a rising tide lifting all boats, potentially.
So let's try and synthesize all this. It's a lot of cross currents.
It really is.
On the one hand, for SCYNEXIS specifically, we have that significant regulatory progress with the FDA agreement. That's a clear positive, a potential value driver.
Definitely a key milestone.
And analysts are clearly seeing huge potential with those very high price targets and dramatic revenue and EPS growth forecasts for 2025 and especially 2026.
Yeah, the hockey stick growth projections are certainly eye-catching, driven by fungerp hopes.
But that optimism is running headfirst into a pretty challenging macroeconomic picture.
Right. Trade wars, tariff threats, global growth concerns, rising insolvencies, persistent U.S. inflation, market volatility.
All creating uncertainty and potentially making investors more risk-averse.
And we know SCYNEXIS stock is already volatile and sensitive to market moves, so it's likely to feel those macro pressures.
Plus, their recent financials showed that big revenue drop in 2024 and negative operating cash flow.
Exactly. So they need to execute perfectly on that drug launch to meet those ambitious forecasts, all while navigating this tricky economic climate.
So it's a real mix. Company-specific potential versus broad economic risks.
That sums it up well. Opportunity is clear, the FDA agreement is tangible progress, but the risks are also clear. Achieving those massive growth targets is a big ask, especially if the economy stumbles.
Okay, so wrapping this up, we've seen the key developments, the numbers, the analyst views, and the wider economic context.
Yeah, the regulatory step forward, the financial picture with its swings and future hopes, and this overlay of significant macro uncertainty.
So the final question, really for our listeners to ponder, given all these cross-currents we've discussed, the company progress, the huge analyst expectations, the economic headwinds.
What factors do you think will ultimately be the most critical?
Right. What will really determine SCYNEXIS's future and ultimately investor returns? Is it the successful execution of the drug launch? Is it navigating the economy? Is it something else entirely?
Definitely a complex picture, lots to think about and keep an eye on. Encourages further research, for sure.